Hello, this is Charlotte Hill, and I lead the Financial Services Regulatory team at Taylor Wessing. And I'm here today for our webinar with our Senior PSL, Daniel Hirschfield, and we're going to be talking about the response from the financial regulators to the COVID-19 crisis. So before we start, you've got a Q&A box on the side of the screen. So if you'd like to ask any questions, please type them in and we will be picking up the questions afterwards, or if there's no time in which to do so, we will come back to you afterwards on that. The other point is that you will receive the slides and a copy of the recording after the webinar. It will be sent to you then. So I've got a nice picture of the virus on our front page, and before we started I was wondering what the thing on the right was. It looks like sort of a strand of DNA or something, but we weren't able to say. So to start, it's the COVID-19 situation is particularly important for the whole globe, and it's a situation that is being closely monitored by financial services regulators everywhere. The Bank of England, the PRA, the FCA, and all the European supervisory authorities have all taken measures and are taking measures to protect markets and consumers, and also to ensure that firms have adequate contingency plans in place. This has actually all come at a particularly important time for the world of financial services regulation. A series of proposals on the regulatory framework for operational resilience are currently out for consultation, and this has come right in the middle of that consultation. And of course, for obvious reasons, operational resilience is a key priority for the regulators, and COVID-19 has brought that into very, very sharp focus. There is new material coming out on this constantly. So we updated our presentation this morning when we had to get our slides in for this, but it is possible that new stuff has come out since. Just about every hour you see something new come out. It's a very, very fast moving area, and it's absolutely essential to keep on top of the developments. So we thought it would be a good time just to have a webinar and summarize what we're seeing coming out from the regulators so far. This certainly isn't exhaustive, though. We've covered some of the main things, but we've also got enough material when we were looking at this for a number of other webinars as well. So it's some of the main points. It's an opportunity to be updated on what's happening, but I mean, this is the first of many webinars to come, I think. So today we're going to be covering the areas there on the contents slide, and I won't bother reading them out to you. You can see them there. But the first topic that we want to be looking at is operational resilience, and I'm going to hand over to Daniel to talk to you about that.
Thank you very much, Charlotte, and good afternoon, everybody. As Charlotte said, we do encourage audience participation, so if you do have any questions as we go through, please do enter them in and we'll try and answer them as best we can during the session, or if not possible, afterwards. Charlotte has already highlighted that operational resilience is very much the watchword of the regulators at the moment, and therefore it's not surprising that when the FCA made its first substantive announcement in response to the COVID-19 crisis, it drew attention to its expectation that all firms have contingency plans in place to deal with major events and to test these. It said that it and the Bank of England would review contingency plans of a wide range of firms. The kinds of things that it would be looking for and at are assessments of operational risks, the ability of firms to continue to operate effectively, and steps being taken to serve and support customers. If there's a particular word which gets repeated a lot in the context of the response from the regulators, particularly the FCA, it's the word reasonable. And they have said that what they're looking for are reasonable steps to meet regulatory obligations. At this time, when many changes are happening and there's a constant stressed situation that one is dealing with, it's really important to engage with the regulator as best as you can, and to engage with your trade associations. Trade associations are actively taking collections of questions on their members' behalf on topics like CAS, client assets, financial crime, AML, investment platforms, MiFID, regulatory reporting, and are a good means of channeling those questions to the regulator. So Charlotte mentioned that the pandemic and the focus on operational resilience comes at a time when the regulators have put out a number of papers discussing this topic of operational resilience. And the regulator has said, oh, go and have a look at CP 1932, Building Operational Resilience, Impact Tolerances for Important Business Services, as a way of trying to understand the regulator's approach to operational resilience. Now, the deadline for this particular consultation paper was originally in April, but has been extended as a result of the crisis to the 1st of October. Operational resilience is defined as the ability of firms and the financial sector to prevent, adapt, respond to, recover, and learn from operational disruption. So prevent, adapt, respond to, recover, and learn from operational disruptions. Now, operational disruptions can take a number of forms. Could be a technology failure, it could be cyber-related, and there are also operational incidents which are outside a firm's control. The approach taken in the paper is to develop a schematic approach to this. So one, first of all, identifies what are the important business services within your organization. Then, having identified those important business services, one sets impact tolerances for each of them. Then, one identifies and documents the people, the processes, the technology, the facilities, and the information that support each of these important business services. That's called the mapping stage, which then leads one on to taking actions to be able to remain within impact tolerances through severe but plausible, to use the regulator's words, disruption scenarios. It's also very important not to forget that firms aren't operating in a silo. Everyone is dependent to some extent on third-party providers, on outsourcing, so one has to be thinking very carefully about what arrangements they have in place to cope with disruption. We're going to move on now to financial resilience. Charlotte.
Thank you, Daniel. I'm just going to do the, as you say, the financial resilience section. We've had a FCA statement on this, which they put out on their website on the 26th of March. And the statement reminds firms that capital and liquidity buffers are there for use at times of stress. Firms should have sound management of their financial resources, plan ahead, and voice any capital requirement concerns with the appropriate regulator, the FCA or the PRA. So the FCA wants to see firms to continue operating in this challenging period. That's a quote from their statement. And they say that they want to provide flexibility to firms to ensure this happens. They do say flexibility insofar as they are able to provide that, or insofar as is possible. So we'll see how that works in practice as this goes through. As I say, yes, capital and liquidity buffers are there for use at times of stress, and firms who have been set those buffers can use them to support the continuation of the activities carried out by the firms. But the FCA does emphasise that firms do need sound management of their financial resources. So if firms need to exit the market, planning should consider how that should be done in an orderly way to ensure an orderly exit, so reducing harm to consumers and markets. Any capital requirement concerns should be raised in the first instance with the FCA and, if appropriate, the PRA, individual regulated. And certainly the FCA is emphasising in a number of different ways, a number of different places, that firms should be planning ahead. The FCA refers to various government schemes, such as the business interruption schemes, to help firms through this period, and says that it should be using those as part of a firm's plans for how they meet debts as they fall due. Of course, not all government schemes are applicable to regulated firms, and so it's important to use the schemes that apply to your particular firm. So on that note, I'm going to pass on to Daniel to talk about key workers in financial services.
Thank you very much, Charlotte. So we'll now discuss a topic which shows how different areas of government regulation have interacted with the response from the regulators. Because the background to key workers in financial services is the government guidance on maintaining educational provision for those essential areas of the economy. And that includes children of key workers in utilities, communication, and financial services. Now, a key financial worker is someone who fulfills a role necessary for a firm to either continue to provide essential daily financial services to consumers, or it's necessary to ensure continued functioning of markets. So it's essential daily financial services to consumers or the continued functioning of markets. The regulators have said that they only expect a limited number of people to be identified as key financial workers, and they have said that the approach which firms should take is to look at the activities, the services, the operations that would cause disruption of essential services to the real economy of financial stability, then look at the individuals who are essential to support these functions, and then also identify any critical outsourced partners. And one can already see that there is a parallel approach there to some of the guidance or thinking about how one approaches operational resilience. So who is responsible for this process? Well, the regulator recommends that the chief executive, SMF1, or a relevant member of senior management team is accountable for ensuring there is an adequate process. Lots of useful guidance on the regulator's website, including an indicative list of roles that may be considered as providing essential services. I won't run through all of these, but just to show you, in the first bullet, there, individuals essential in the overall management of the firm. For example, individuals captured by the senior managers regime not surprisingly, these are considered to be roles which are capable of being key worker financial services roles. In addition, risk management, compliance, audit and other functions necessary to ensure the firm meets its customers' needs and its obligations under the regulatory system are likely to be considered essential services. And anybody who provides essential support to allow the functioning of the above roles, such as finance and IT staff. Firms have been told that they should consider issuing a letter to affected individuals confirming their status as a KWF, a key worker in financial services. An interesting development which we saw was some guidance on a point which is not specifically related just to key workers in financial services, but this broader question, which is when is it essential for somebody to go out to work? And the FCA has said that there are scenarios where clearly somebody may need to travel to the office, but it's for the designated senior manager, the relevant member of the senior management team, who is responsible for identifying which of their employees is unable to perform their job from home and must travel to the office or business continuity side. It's their responsibility to manage that exercise. Again, the FCA has said that it expects the population to be far smaller than the population of workers needed to ensure the firm carries on business as usual, and that firms should discuss working arrangements with employees and what steps can be taken to facilitate working from home, including providing suitable IT and equipment to enable remote working. FCA has also said that it doesn't expect the following would need to go into work or have face-to-face meetings. So financial advisors, business support staff, staff who can safely and securely trade shares and financial instruments from home. I think one of the really key practical steps which comes out of this, because there have been these incremental additions to the guidance, is to try to keep abreast of the government's guidance and any recommended steps that the FCA suggests. And I think it's a very, very helpful thing to do, if people haven't done so already, to sign up to the gov.uk COVID-19 updates. That brings us on to market trading and reporting, and back to Charlotte.
Thank you, Daniel. So market trading and reporting. The FCA is expecting firms to consider the broader control environment in these new working circumstances, and also to satisfy the ordinary recording and reporting standards to which they're subject anyway. Firms need to be considering these steps that they need to be taking to mitigate the outstanding risks, the FCA says, although it says that it does understand that there may be difficulties in doing so. It doesn't really give any further information on what sort of difficulties those are or what sort of leniency it may give as a result of that. But it suggests that people should liaise with the FCA as necessary. So, in other words, keep up that line of communication. We have had something from on the European side, and the materials coming out from the European supervisory authorities have been absolutely legion as well, and we just concluded we couldn't include them all in this. But just to mention this one, there's been an ESMA, European Supervisory Markets Authority, there's been an ESMA statement on market trading and reporting. It's an initial public statement that came out on the 11th of March 2020. And that highlighted the ongoing priority of ensuring business continuity. And the statement also makes various recommendations to firms participating in the financial markets. And that includes recommendations and specific reminders to issuers of the need to disclose any relevant significant information concerning the impacts of COVID-19 on what it describes as being their fundamentals, so the fundamental things that they need in their business in order to function, their prospects, so looking forward, or their financial situation, as soon as possible in accordance with the financial abuse regulation. So reminding them of their obligations there, and also reminding them to provide transparency in any financial reporting disclosures. Then a little bit later on the 20th of March 2020, ESMA actually extended the response date for its ongoing consultations, and that's as of the consultations due to close on or after the 16th of March 2020. And it's extended the response date by 4 weeks in each case, and that's to allow institutions to be able to focus on their core operations, ESMA said. ESMA has also issued a public statement on the recording requirements of telephone conversations pursuant to MiFID II. And it acknowledges that recording may not be practicable in certain circumstances, but it expects firms to mitigate any potential risks and to use all possible efforts to restore the recording of telephone conversations as soon as possible. So, in other words, record your telephone conversations, but if you can't, it looks as if there's going to be some measure of leniency there. And so I'll hand back to Daniel for short selling.
Thank you very much, Charlotte. Short selling has been a very interesting topic in the context of COVID-19 because one has seen a difference of approach among the regulators. Just to recap, the EU short selling regulation allows EU regulators and the FCA, in case anyone had forgotten that the FCA is no longer an EU regulator, to apply short or long-term bans on short selling of shares and certain other financial instruments. And indeed, a number of European regulators, Austria, Belgium, France, Greece, Italy and Spain, have issued temporary short selling prohibitions in response to the volatility in trading. Now, the FCA on its website has drawn attention to these, but aside from a few intraday temporary prohibitions which it has introduced or did introduce near the beginning of the crisis, to date, and it is the current position, that it has not introduced a similar ban. It says that it has no evidence that short selling has been the driver of recent market falls. It sets a high bar on any ban, but it continues to coordinate with international partners and take all actions within its power where necessary to safeguard orderly markets. And there was a very emphatic statement from Andrew Bailey speaking in March, which simply said, just stop what you're doing in relation to those who might be tempted to engage in short selling behavior at the current time. What has happened, though, is the FCA has followed a ESMA announcement bringing into effect a temporary change of the notification threshold to regulators from 0.2% to 0.1% of issued share capital. And the FCA has followed this. From today, it is ready to receive notifications. Firms are not required to amend and resubmit notifications submitted between the 16th of March and the 3rd of April. And if firms have difficulties amending their systems in time, they should email pmu@fca.org.uk to discuss further. Charlotte.
Sorry, I couldn't find the mute button for a moment. So I'm going to just mention the, sorry, let me just find this. Right, yes, I'm going to just mention the securities supervising reporting under the Securities Financing Transactions Regulation, the SFTR. And that, for people who haven't been aware of it, just a very quick overview of what this is. And it's a new regulation that introduces requirements to improve transparency and also to monitor the risks associated with securities financing transactions. So, for example, repo transactions, securities lending transactions, margin lending transactions, and commodities lending transactions. It applies to non-EU and non-UK firms if the securities financing transaction is concluded through an EU or UK branch, so it could apply to a UK firm. And the requirements are there. Reporting requirements, report details of securities financing transactions, and there are also certain disclosure obligations. That again has been caught by the COVID-19 attentions of the FCA, and it has updated its SFTR website recently on the 26th of March. And the FCA has said that it won't be prioritising supervision of the new reporting obligations between the 13th of April and the 13th of July this year. And that includes securities financing transactions under the Markets in Financial Instruments Regulation, MiFIR. The FCA also concurs with the ESMA Statement on changes to the tick size regime for certain firms. And it says that it will, and this is a quote from the statement, it will not prioritise supervision of the new requirements at this time, and it said it expects firms to focus on minimising the potential for operational disruption. So for perhaps one of the first times ever, this is actually, the COVID-19 crisis has actually derailed the implementation of a new regulation. Passing on to Daniel again for listed companies.
Thank you very much, Charlotte. We thought we would just mention something about listed companies. In addition to regulating some 58,000 businesses, the FCA is also the UK securities regulator, and not surprisingly, it's published a fair bit of guidance on how COVID-19 impacts listed companies. Some points to draw out from its primary bulletin number 27, which is notoriously titled a special COVID-19 edition. Ongoing disclosure obligations under the Market Abuse Regulation continue to apply, and transaction notifications. Market volatility and suspension of trading, something that the regulator keeps under review, whether in fact it may be necessary to suspend trading. It has discussed shareholder meetings, recognizing that it may be necessary, particularly that we're in the coming to the season, the AGM season, for these meetings to take place virtually, and has allowed, as regards corporate reporting, it has allowed the issuers an additional 2 months to publish audited financial statements. It's also keeping under review the approach towards corporate transactions and admissions. Now that applies to the main market. AIM companies, they've also seen some guidance in the form of inside AIM guidance notes from the London Stock Exchange. So we've seen statements to the effect that there is discretion in how AIM rules for companies and AIM rules for nominated advisors, nomads, will be applied, and following the extension that Company House has put in place, it will be allowing companies to request a 3-month extension to the reporting deadline for the publication of annual audited accounts. We have, or our colleagues, I should say, have put together a web page on practical considerations for listed companies arising out of COVID-19, which we encourage you to take a look at. I will carry on and talk to you a little bit about insurance matters. Now, not surprisingly, since we're seeing this among the different sectors, there are specific FCA web pages with information for consumers and further expectations of firms as regards insurance. And we can see here that operational resilience is just as relevant to insurance as it is to any other sector. And so the FCA has said, and this is becoming a leitmotif of its announcements, that it is essential to have plans in place to manage and mitigate the operational impact of COVID-19. Firms should have sufficiently robust systems and controls to operate effectively in stressed situations and business continuity plans to manage this. Firms should have a senior manager responsible for business continuity and for managing the impact of COVID-19. There's a little bit of difference here in approach potentially between what it said elsewhere, where it has said that it wasn't necessary for COVID-19 to be allocated to a specific senior manager, but in the area of insurance, it seems to be suggesting that. But certainly as regards business continuity, there should be a senior manager responsible for that. And then those cardinal principles which underlie regulation, the need to act fairly, honestly and professionally in accordance with the best interests of customers, and the need to ensure that all customer communications are clear, fair and not misleading. So there are some practical steps that should be taken and firms should be considering. They should be considering the impact of staffed absences and how to ensure staff well-being when returning. They should look at how best to mitigate the impact of staffed absence and the inability to use business premises to ensure critical services are provided to customers, and should be looking very closely at whether there are any gaps that will or could cause harm to consumers. And if there are, they should be notifying their FCA supervisory contact. The expectations that the FCA has extend to brokers. The FCA thinks and has said that brokers have a very important role to play to help consumers to understand the market, to help them understand the impact of COVID-19, and to help them search the market for products that meet their demands and needs. A note here about Lloyd's of London. Lloyd's of London confirmed on the 26th of March that it is in a strong position to respond to the impacts of COVID-19 and supports its customers and business partners. It has in fact put in place emergency trading protocols. The market remains open, but it has closed its underwriting room. And in fact, if you go to the Twitter feed for Lloyd's, you will be able to hear the ringing of the famous Lutein bell, which was salvaged from HMS Lutein, which was rung once as the market, hopefully temporarily, the underwriting room that is, temporarily closed. Charlotte.
It's always interesting that about the famous Lloyd's bell, isn't it? So you can actually go to Lloyd's and you can see it there. So I'm just going to say a couple of words about strong customer authentication, which was really very much flavour of the month until this came along. And recently the FCA has come up with an updated statement on it that was published on the 31st of March. And the FCA says that firms are expected to protect customers and to monitor their fraud rates and take swift action if they notice those fraud rates rising. The FCA has also recognised that firms are facing increased pressures, and so as a result it has introduced some changes. It says that it will be very unlikely to take enforcement action if a firm fails to apply strong customer authentication to cumulative payments exceeding €150 or 5 consecutive contactless transactions in a row, but only if the firm has the necessary fraud monitoring tools and the systems in place, and only if it makes every effort to mitigate those risks. It says also that it will work closely with the industry in order to manage the time frame and milestones for the implementation of strong customer authentication for e-commerce ahead of the deadline of the 14th of March next year. And the FCA also says another change. It says that it will consider, but only on a case-by-case basis, the next steps for firms that have not met their strong customer authentication requirements for online banking, which would have applied since 14th of September last year, though there is an adjustment period until the 14th of March 2020. So the FCA is showing a little bit of leniency there for strong customer authentication requirements, and in fact I think is trying to be a bit flexible, trying to give firms a bit of a break generally. So I'll hand back over to Daniel again to talk about regulatory change.
Thank you, Charlotte. And it may seem a bit odd to be talking about regulatory change at the moment, but as you'll see, what we're looking at here is the approach that the FCA has been taking to making changes at this time, and its approach to some of the ongoing policy work streams and some other significant announcements that the regulators have made as regards disclosures and reporting. So there was a very helpful Dear CEO letter on the 31st of March, which set out the FCA's approach to requests from trade associations and firms. And in fact, it's a threefold approach. Where the FCA has power to make the changes, and it believes those changes will support firms and customers, it will make those, prioritizing them according to harm or urgency involved. However, where there are changes which will support firms and customers but require cross-regulator collaboration, it will pursue these, but it acknowledges that it may take more time. And then there is a residual category of what the FCA considers to be a small number of changes, which it does not in fact believe are in the interests of consumers or would impair its ability to manage the crisis. In such a case, it will refuse the request. So that tripartite approach should, I think, help you when it comes to thinking about what are the really high priority things that one should be lobbying the regulator about, going to the trade association about, to see change. I should add that where there are speculative or rather people requiring amendments which are certainly not in the interests of consumers, the FCA has made it quite clear that it will take a dim view of this and it will consider if there's anything untoward going on in the particular sector. So just to illustrate how the FCA can make changes and can make changes incredibly quickly, at the end of last week, we saw an announcement of a proposal for temporary relief for customers impacted by COVID-19. This complements the government's support to mortgage borrowers and renters and assistance to employees in the furloughed scheme and self-employed. It expects firms to offer a temporary payment freeze on loans and credit cards for up to 3 months, to offer zero interest for up to 3 months on pre-arranged overdrafts of up to £500, and to ensure overdraft customers are not worse off on price. It intends that its proposals will protect the credit ratings of consumers using the temporary measures. The consultation period for this set of measures was incredibly short. In fact, it concluded at 9 AM today, and the FCA intends to bring the measures into force by Thursday, the 9th of April. That is Thursday later this week. I mentioned impacts on policy work streams. So what has been the impact of COVID-19 on FCA policy work streams? Well, a number of consultation papers and calls for inputs deadlines have been extended to the 1st of October 2020, including the CP24 quarterly consultation paper, and as we mentioned earlier on, CP1913, the operational resilience paper, and the open finance call for input, and the call for input on accessing and using wholesale data. Initiatives relating to investment pathways and platform switching, the rules have been made and have been referred to the FCA board for their consultation and therefore are going ahead. The ongoing work with firms providing defined benefit transfer advice continues. There's a delay now to the policy statement on pension transfer advice and a pausing of follow-up work on assessing suitability of advice, which was in the pensions sector. So one of the things we've seen, and in a sense we've had to see this, is regulatory flexibility. Just to mention a few, when it comes to AML, well, the client identity verification must continue, but firms can make use of remote checks. And these are methods which have already been discussed in some of the guidance. So, for example, using scanned documentation by email. And then we have, I think, possibly the first and only reference in a Dear CEO letter to the word selfie, the use of selfies or videos, gathering data to triangulate evidence provided, and using codes to verify phone numbers, so on. As regards best execution, again, flexibility here. The obligation still continues, but firms should take account the current market conditions when assessing execution factors, consider using different types of order to execute client orders and manage risk during market volatility. The FCA has said that it is not intending to enforce failure to publish the various RTS reports, provided they're published by the end of June. Another area of supervisory flexibility in relation to portfolio management services or holding retail client accounts with leverage instruments. And then finally, since we haven't focused specifically on some of the PRA statements as regards reporting, the PRA has also made statements in relation to regulatory reporting for banks, such as Pillar 3 disclosures and Solvency II disclosures for insurers. So before we wrap up this webinar, we're going to take a look at the SMCR, the Senior Managers and Certification Regime. This was something which got some further guidance just at the end of last week, and so we decided that it was absolutely imperative to include it here. And I think also because in the wake of the financial crisis, there were things which went wrong in organizations, and there was, as a response to that, a very real need to put in place a regime which would hold senior managers to account. So now, unfortunately, senior managers really are under the spotlight because their actions or their failures to take action could lead to FCA follow-up work in the months and years following the end of the crisis, if it emerges that there were steps that they should have taken or should not have taken. Now, I said that the insurance guidance suggested that there needed to be a single manager responsible for the COVID-19 response, but in general terms, the FCA's statements overall have said that firms are not required to have a single senior manager responsible for their COVID-19 response, but they should allocate responsibilities to best ensure they can manage the risks they face. Of course, if you're an enhanced scope firm, so that very small population of firms which has the most onerous requirements under the regime, there are two functions which lend themselves to two of the topics which we've covered today. The SMF24 Chief Operations function lends itself to operational resilience, SMF2 Chief Finance function to financial resilience. I've already talked about key worker designation, and that being the responsibility of ideally the SMF1 or another member of the senior management team. Senior managers are responsible for the risks in their areas of responsibility and should consider where the current situation might lead to emerging risks and how it affects existing risks, along with the controls used to manage them. So overall, and I think we can definitely expect this, an increased focus on senior manager accountability. In fact, the various methods and package of measures for business support which have been announced have come with a warning from the regulator that they will be watching how the banks use these funding methods and make them available, and will look at senior managers to be accountable for their proper use. Moving on quickly, statements of responsibilities and significant changes. So the FCA has said that it won't enforce the requirement for updated statements of responsibilities if there's a change covering multiple sicknesses, other temporary changes in responsibilities in direct response to the pandemic, and they're temporary and they're expected to revert to firms' previous arrangements. But, and this is an important but, internal documentation must be kept up to date. Fixed portfolio firms should update the FCA of business as usual changes in the statements of responsibilities, and the FCA is to be updated of any senior managers who are put into furlough. The FCA will be putting in place a modification by consent to the current requirement or provision for 12-week absence covers, whereby a temporary cover of 12 weeks can be extended to 36 weeks. Prescribed responsibilities can be allocated to the person standing in. The FCA expects these to be allocated to another approved senior manager if possible, though. Again, internal documentation must be kept up to date, including the statements of responsibilities, and the covering manager will require access to relevant governance forums. Not long to go. On furloughed staff, firms might have to furlough senior managers if they're unable to fulfill their responsibilities. Furloughed managers will remain approved unless they're permanently removed from or permanently leave their post. Firms are still responsible, though, for ensuring the senior manager is fit and proper. Prescribed responsibilities should be reallocated. Required functions, that's compliance oversight, the money laundering reporting officer, and the limited scope function for limited scope firms, well, these should only be furloughed as a last resort. Also, since the changes and guidance which I've just mentioned are for solo regulated firms, also please take into account that there is a separate statement which has some areas of commonality, a separate statement by the FCA and the PRA on SMCR expectations for dual regulated firms. And on the topic of dual regulated firms, the Certified and Assessed Persons Directory, the publication of this directory has been delayed from the end of March by at least a month. Dual regulated firms can either regularly update their information or provide a bulk update once the new launch date has been confirmed. Charlotte.
Thank you very much. Thank you very much, Daniel. There's a lot of material there that we've covered this afternoon, and I should think we will come off the webinar now and find yet more has been published. So thank you very much for attending. We've got a slide now with our contact details on it. If you would like to ask any questions or just have a chat to us, one thing about being in lockdown as we are, everybody is, quite amenable to having a chat with a genuine human being. So do get in touch if you'd like to talk about anything that we have raised today, or indeed anything else at all. As I said at the beginning, this is going to be just the first of a number of webinars, so hope to see you again soon. Thank you very much.
And thank you very much from me. Finished just in time for the 5 o'clock Downing Street briefing. Bye-bye.
That's right. Bye.